Hello again, fellow virtual consultants. Thank you for joining us for our end of year tax tips for your virtual consulting business. In this video, we will share with you 7 smart year-end tax planning moves for your small business, for your virtual consulting firm, for your virtual consulting business, how to get your business taxes in order before the end of the year with 10 additional tips for your virtual consulting business, 5 hidden ways to boost your tax refund, 10 ways to reduce your company tax liability, and how to minimize your small business tax liability for your virtual consulting business, top year-end planning tactics for small business owners, 8 year-end tax tips for small businesses like your virtual consulting business, and 6 year-end tax planning tips for small business. Additionally, we will share with you how you can utilize trade or barter to, again, minimize your tax liability, reduce your taxes for next year, and also conserve your cash to help grow your virtual consulting business. So stick with us through the video, and again, at the end, we'll also add some additional trade and barter tips, how you can utilize trade and barter to conserve your cash throughout this high inflation, recessionary, high interest rate economic environment that we're going with. So again, stick with us through the end. We've got a ton of end of year tax tips to share with you to help you minimize your tax liability, conserve your cash, and help your virtual consulting business grow. So let's get started.
Seven Smart Year-End Tax Planning Moves for Small Business Owners by David Ray. While some of you may still need to file your 2021 taxes, the 2023 tax season, filing your 2022 taxes, is just a few months away. New Year's Eve will be here before you know it, and with the stroke of midnight, many tax-saving strategy deadlines will have passed. The fourth quarter each year is the time for some proactive tax planning to lower the tax liabilities of your small business, hopefully with a high income. For successful business owners, tax planning shouldn't be a once-per-year exercise when filing your taxes. With extensions, you may be able to delay filing your 2022 taxes until late 2023. However, many tax planning moves that can help lower your total taxes owed may need to be made before the end of the current year. Review your estimated net income. Has your income jumped substantially? Has soaring inflation sapped the profitability of your business? Changes in your income, either up or down, can significantly change your tax planning for the year. With a higher income, you may want to be more aggressive in looking for tax deductions. On the flip side, when your income drops, you may become eligible for other tax breaks that you haven't considered in the past. Are you using the best business entity? What corporate structure are you using for your business, if any? Are you a sole proprietor, S Corp, LLC, partnership, or C Corp? As your business and income grow, the best structure for your business may change. If you are making $50,000, the time and effort and cost of setting up an S Corp likely isn't worth it. However, the tax planning math often changes as you earn 6 figures or more. You should review this with your tax professional and tax planning certified financial planner every few years, more often if your business is growing rapidly or if there have been changes to the ownership. Optimize your business retirement plan. One of the best ways for small business owners to slash their taxes is to establish and fully fund a retirement plan. This could be anything from a SEP IRA to a solo 401k or a combination of a 401k with a cash balance pension plan. Would you rather write a big check to the IRS or your retirement account? I know which choice I prefer. High-income small businesses can potentially defer income taxes on hundreds of thousands of dollars annually. Here are a few of the most common retirement plans for high-income earning small business owners. SEP IRA. If you are self-employed, you can contribute 20% of your self-employment earnings into a SEP IRA per year. The maximum contribution to a SEP IRA is $61,000 for 2022. There are no catch-up contributions for SEP IRAs. With no year-end deadline, a SEP IRA can be set up and funded just before filing your taxes for the previous year. Solo 401k. Typically, A solo 401k will allow for the largest pre-tax contributions, which should translate into the largest tax savings. Business employees can contribute up to $20,500 for 2022 plus a $6,500 catch-up contribution if they are at least 50 years old. Additionally, the business can make a profit-sharing contribution, up to 25% of payroll. That means $61,000, or $67,500 for those over 50, in allowable 401k contributions in 2022. You can also benefit from a Roth Solo 401k for the employee portion of your contributions, $20,500 plus a $6,500 catch-up contribution for business owners over 50. If your spouse also works with you in the business, they can be included in the plan, doubling the amount you can contribute and the tax savings. Defined Benefit Pension Plan. For business owners looking to save even more on taxes, the Cash Balance Plan, combined with a 401k, could allow your business to shelter several $100,000 in income each year. You may also hear this called a Defined Benefit Pension Plan. More likely, your basic financial advisor or CPA won't mention it all, sadly. Defined benefit pension plans are the most complicated of the small business retirement plans because the plan design is complex and time-consuming. If you are nearing 50 or older, are already maxing your 401k and want to save even more, talk with your tax planning financial planner ASAP. If they aren't able to help you determine if a cash balance plan is right for you, talk with someone who can. Many financial advisors are unable or unwilling to do the work to set up a cash balance plan. Cash balance plan contribution limits will depend on the age and income of you and your employees, but they can often run north of $150,000 per business owner annually. Double this if your spouse also works in the business with you. The tax savings can be huge, especially for those in high-tax states like California and New York. Are you eligible for the home office deduction? These days, small business owners are more likely to work from home full-time. Business owners reading this who work from home may be eligible to take the home office deduction. Here is what you need to know to determine if you qualify and better understand how this often scary home office deduction works. This valuable tax break can save hundreds, or even thousands, of dollars in taxes each year. The best part is that you are already incurring these expenses for housing regardless of your business use. Take the time and discuss the home office deduction with your tax preparer to make sure you qualify. Don't ignore your bookkeeping. I hope the days of filing your taxes from a shoebox of receipts are long behind you. Even when organized, filing your business taxes can be time-consuming and stressful. Please plan to spend a little time throughout the year to stay up to date on your bookkeeping, or hire someone to do it for you. Claim first-year bonus depreciation. One of the positive changes from the Tax Cuts and Jobs Act, TCJA, is that you can now get a 100% first-year bonus depreciation for qualified used and new property acquired and placed in service during your 2022 business year. To put this more plainly, you may be able to get a tax break for the entire cost of assets purchased in 2022. If you have a big income year, you may consider moving up some planned purchases into 2022. Planning ahead, these tax benefits begin to phase out after 2022. Stay proactive with your tax planning. With proper timing, from proactive tax planning, your income and deductions could become even more valuable. For those who use pass-through entities, sole proprietor, S-corp, LLC, or partnership, your portion of the business profit and deductions are passed through to you and eventually taxed on your own personal tax returns. Taxes are based on your overall household income and filing status. We are expecting some changes to tax brackets in 2023 and some increases to retirement plan contribution limits. For the self-employed, minimizing taxation is one of the best ways to increase the net profitability of all your hard work in your business. Be proactive and work with your tax planning certified financial planner and CPA to develop a strategy to make proactive tax planning choices that will help you keep more of your hard-earned money. In the case of retirement accounts, would you rather write a check to yourself or the IRS? The choice is yours.
Tax prep can be time-consuming, but if you fall out of compliance with the U.S. tax code, your business could face penalties. Review these common end-of-year practices to develop good tax habits. Work with a CPA or certified tax professional to ensure that your business is taking full advantage of deductions, write-offs and other tax advantages. Working with professionals will also ensure you're staying informed about constantly changing tax laws and regulations. Besides tax organization, the end of the year is a good time to strategize how you want to prioritize spending and push expenses. For example, by pushing expenses from December 31st to January 1st, you can reduce your taxable income for the current year. Work with your HR department or office manager to ensure your employees, be them full-time, part-time or contract-based, receive the appropriate tax forms. This advice is ideal for small business owners looking to learn more about the tax process before speaking with a CPA or tax professional. To keep that from happening to your small business, you have to be smart with how you tackle business tax preparation. Even though tax season doesn't officially begin until next year, it's in your best interest to take a few steps today to prepare your next income tax return. If you want to end the year on a tax-based high note, here are some steps you can take to get ahead of the game. Get your business taxes in order before the new year with these 10 tips. The third quarter of 2020 ended on September 30th, and businesses everywhere are reaching the final stretches of the financial year. As such, now is an excellent time to create an updated projection for the final quarter. If your small business has been in operation for a while now, you should have a general idea of how it tends to fare during the final few months of the year. A.J. Gross, president at Alge Group, said knowing your business is key to putting together an accurate projection. You need to be able to see where you think the business is going to end up overall for the fourth quarter of 2019, he said. If you plan on growing or expect a downturn, it's entirely based on the entire year and your business cycle. For example, if your business winds down during the summer with sales slowing to a crawl during the holidays, you should already have prepared for that kind of slowdown. Conversely, if you own a retail store, you know just how swamped you and your employees will be once Black Friday rolls around. Since most small businesses pay estimated taxes based on the previous year's figures, you should try to determine how the past 3 quarters compare to last year. The estimated tax payment method enables small business owners to keep track of their expenses in the build-up to tax filing in April, and offset any costs that occur between this period and their final submission to the IRS. If you find that your estimated income taxes were close, you can use that information to determine whether you need to increase your tax payments because of an increase in income or save funds for when you file your tax return. You may not necessarily want the government to hold on to your money, so you can pay the minimum amount, Gross said. However, it may be good to have a certain amount saved in case you know you're going to owe taxes based on a better year in 2019. Key takeaway: compare the first 3 quarters financials with last year's numbers to get an idea of how your tax situation is shaping up. Consider making large year-end investments. When it comes to filing taxes, deductions are your friend. Saving money on taxes always feels good and ensures that you're taking advantage of government-sanctioned exceptions. One way you can increase your tax deductions is by making upgrades or capital improvements near the end of the year. John J. Petosa, a licensed CPA, attorney and faculty member at the Whitman School of Management at Syracuse University, advises businesses to consider purchasing new equipment or certain other business property that will qualify for a Section 179 deduction. Under that deduction, small business owners can seek out deductions for all or part of the cost of certain qualifying property in the year you put that item into service. If you were waiting on that new computer system, you may wish to buy it now, and put it in service this year, and write it all off, which reduces your overall taxable income, said Petosa. Often, I will suggest that my clients create a separate bank account for taxes and put a percentage of their receipts in that account to save it so they are not short on tax day. While Gross agrees with that sentiment, he added one major caveat: it has to make sense in the near or short term. You only want to make investments that will improve the profitability of the business, he said. If it doesn't improve your profitability, it doesn't make sense. For example, if you want to purchase and deduct a $50,000 piece of machinery with a 30% tax rate, you will save $15,000 in tax savings but will still be down that $50,000. Key takeaway: consider making upgrades or capital improvements near the end of the year to increase your tax deductions. By spending more on deductible items, you can reduce your overall income. Check your retirement plan. Perks are incredibly powerful ways to attract and keep new employees. While many small businesses offer offbeat perks to sweeten the deal, the tried and true benefit of retirement plans is still a major boon to workers. As you prepare your taxes, you may want to look at your retirement offerings. Small businesses have access to specially qualified retirement plans outside of the typical 401k or IRA. Simplified Employee Pension Plan (SEP) programs can help you put away up to 25% of your income, up to $54,000. The nice thing about some of these plans is if you put together a SEP, you don't have to contribute the funds until the due date of the return, and if you file an extension, you can have until the extended due date, even though you will have already taken a deduction on the return, Gross said. Key takeaway: review your retirement offerings and consider programs outside of typical 401k and IRA programs. Alternative plans may allow you to put away up to 25% of your income. Check for obsolete inventory or uncollectible debts. There's a certain amount of risk in running a business, and, unfortunately, some items just don't sell, and some debts can't get collected. While neither situation is ideal for any business, they are both deductible. Old inventory, or inventory that can no longer be sold, is deductible as an expense come tax time. Since inventory only gets expensed when it's sold, Gross said you can get rid of the items that can't be sold and deduct what you originally paid for them. The same concept applies to uncollected debt, though what constitutes an uncollectible debt depends on your business model. In either instance, you'll need proper records to prove both situations. Key takeaway: old inventory is deductible. Analyze what you have on site, and consider more creative deductions, like uncollectible debt, and determine if you can reduce your taxable income. Remember, cash-based businesses can be more flexible. If you run a cash-based business, you may want to consider how you report your income and costs near the end of the year. Cash-based businesses must record their income and costs only when they're received or spent. With that in mind, Gross said you may want to think twice about how you send and receive payments near the end of the year. If for any reason you're near the end of December and you have the option to defer receiving a check until the following year, you can potentially do that because you didn't receive the cash until the following year, Gross said. Same goes for expenses. If you write a check and it doesn't get cashed until 2020, it's still an expense in the current year. Depending on how you handle your year-end cash flow, Gross said you can essentially accelerate your expenses while deferring your income. Key takeaway: cash businesses have more flexibility with how their income and costs are recorded. Review your year-end cash flow, and work with a CPA to understand what expenses can be deferred. Hire a small business tax professional. As an individual, you may be your own bookkeeper or tax preparer, but it's relatively easy to file your own tax return thanks to accounting software applications and other services willing to provide worthwhile tax advice. For a small business owner, however, it might be better to have a tax expert prepare your taxes. American tax law is incredibly complex. While failing to properly file your income or payroll taxes as an individual can become an untenable tax situation, it can spell doom for your small business. Falling behind with your business taxes can lead to tax liens or levies, wage garnishment, and the end of your company altogether. According to the IRS, if you owe more than $1,000 in taxes, you must make estimated tax payments in the amount of 100% of last year's tax liability, or 90% of the current year's liability, whichever is smaller. If you do your business taxes on your own, Gross said the same tax forms apply that were around before the Trump administration's bid at tax reform, the Tax Cuts and Jobs Act of 2016 passed. Even though that piece of legislation was sold as a way to simplify the entire process, Gross said it made things more difficult. The latest changes actually made things more complicated for small businesses, since it changed how and what you can deduct. If you have a pass-through business, such as a sole proprietorship, partnership or S-corporation, the law allows for a 20% income tax deduction, though married individuals who own certain businesses like law firms or doctors' offices can only claim it if their yearly income is below $315,000, or $157,000, if single. The law also changed what kind of expenses are deductible. While a percentage of business dinners and lunches can be deducted, businesses can no longer expense leisure activities like tickets to concerts or sports events. If you opt to get tax preparation help, the cost of those services will vary by the size of your business. If your operation has a small number of employees, your costs can be upward of $500, while larger businesses can expect to pay as much as $2,500. Regardless, Gross suggested that you take the potential for catastrophe out of the equation and hire a pro if you rely on your business for income in any way. An established business should probably hire a tax professional, just because of the amount of deductions and tax planning necessary, he said. You're definitely less likely to get in trouble by doing something by mistake if you hire a professional. Key takeaway: while these tips are a good starting point, it's not a substitution for working with an experienced tax professional. Donate to charity. Many businesses donate a portion of their income to charity. Not only is a donation a noble and important act, it can help reduce taxable income. By donating to charity, you can better your small business's finances. While money is always a great donation, items like clothes, shoes and toys can also go a long way. Be sure to keep receipts and other documentation to back up your deductions. Key takeaway: while donating cash is a good way to earn a deduction, consider donating other items, like toys or clothes. Defer income. Depending on your income levels during the holiday season, you might consider pushing that income to the following year to save on taxes. Income earned on December 31 counts for the previous year, while income earned on January 1 can be logged for the upcoming year's taxes. Talk with an accountant or tax professional before doing this, as it may not make that much of a difference. Key takeaway: review your cash flow with a tax professional and consider deferring certain income to the next year. Accelerate expenses. Think of accelerating expenses as the reverse of deferring income. Instead of deferring payments, though, you spend money up front on certain expenses so you can earn a tax deduction in the current tax year, rather than the following tax year. Accelerating expenses only makes sense in certain scenarios. Check with a tax professional to see if this strategy is right for your business. Key takeaway: accelerating expenses may make sense for businesses looking to earn deductions on certain payments for the current tax year. File end-of-year tax forms. While tax forms for your business's income and operation aren't due until mid-April, you likely need to submit important forms related to your business and its employees by the end of the year. These forms include Form W-2. This form reports wages your business has paid to its employees, and the taxes withheld from those wages. While this form has more relevance to the personal income tax levels of your employees, it's still your business's responsibility to file them with the Social Security Administration. Form 1096. If your company employed contract workers during the year, you'll have to submit 1096s. These forms function in a similar capacity to W-3s, only they're applicable to independent contractors who receive 1099s. Form 941. This form is used to account for taxes paid to programs like Social Security, Medicare and income taxes. Form 940. This form covers federal unemployment tax, FUTA, which accounts for taxes businesses have to pay for unemployment compensation. Form 1095-C. If your small business provides health insurance to its employees, you'll have to file this form. These forms address which employees received coverage and can be used to determine eligibility for tax credits. Key takeaway: your business is responsible for providing certain forms for workers. Review who you employed for the year and ensure you provide the right forms to the right employees.
This is TurboTax Tips, expert tips for real people. Most recently, we learned about ways to smartly invest your tax refunds. Now, with our newest series, 5 Hidden Ways to Boost Your Tax Refund, we're sharing some not-so-obvious strategies about how to reduce the taxes you owe or increase your tax refund. Today, in part 1 of our series, we're taking a look at our first tip, how rethinking your filing status could impact your taxes. So here's what you need to know. One of the first decisions you make when completing your tax return is choosing a filing status. That one decision can affect the size of your refund, especially if you're married. And while approximately 96% of married couples file jointly each year, a joint return may not always be the most beneficial choice. You may want to consider married filing separately instead. Here's why. While the married filing separately status might require more effort, under the right conditions, the time you invest could mean tax savings. For instance, say you or your spouse have medical expenses like COBRA payments resulting from a job loss. Then filing separately may sometimes allow for a larger deduction. Or if you have children, you may be able to take advantage of the child tax credit that's available to separately filing spouses. The full credit is $2,000 per qualified child for 2020 and can now be claimed by a separate filer with less than $200,000 in adjusted gross income. But keep in mind, if filing separately, only one of you can claim the child and the credit. Choosing to file separate returns does have its drawbacks, though, such as losing other deductions available to joint filers. So what should you do? Compare your options. Calculate your taxes both ways, jointly and separately, and see which way points to a higher deduction. And remember, when you use TurboTax, we'll do this calculation for you and recommend the best filing status for your situation. But what about single folks out there with dependents? How can rethinking your tax status help you? Well, here's an option. Unmarried taxpayers who claim a qualifying dependent can often cut their tax bill by filing as head of household. A qualifying dependent can be a child who you support financially and who has lived with you for more than half of the year. Filing as head of household gives you a higher standard deduction and more favorable tax brackets compared to filing as single. And don't forget, a qualifying dependent isn't always defined as just your child. They can also be an elderly parent you support. In fact, many taxpayers who care for elderly parents don't realize they can claim the head of household status. So if you provide more than half your parents' financial support, even if your parent doesn't live with you, you might be able to file as head of household. Check out our podcast series, How to File as Head of Household, to learn more about it. Today's takeaway: carefully consider your filing status before filing your taxes. Your decision could affect your refund size as well as your tax liability. There's no need to pay more than you owe. For more information about TurboTax Live, visit turbotax.com, where you can file with the help of an expert or let an expert file for you. This is TurboTax Tips, expert tips for real people. Today we bring you tip number 2 in our series, 5 Hidden Ways to Boost Your Tax Refund, and that is, embrace your tax deductions. Because if you're like most people, there are certain deductions you may have overlooked, and some you may not even be aware of. And if that's the case, you might be missing out on deductions that could significantly impact your refund. So let's go through a few of them and see which ones you might qualify for this year. Grab a pen, because you might just want to jot some of these down. First off, state sales tax might be a bigger deduction, especially for people who live in a state that doesn't impose income taxes. Surprised? So are many people. Use the IRS's sales tax deduction calculator, search Google, to determine how much of your state and local sales taxes you can deduct. Next, take a look at your reinvested dividends. This isn't technically a deduction, but it can reduce your overall tax liability. When you automatically have dividends from mutual funds reinvested, include that in your cost basis. This way, when you sell shares, you might reduce your taxable capital gain. Third, have you made any out-of-pocket charitable contributions during the year? Whether it was buying the ingredients for a cake you donated to a bake sale or a small monetary contribution to a local charity, keep track of it. You'll be surprised how quickly these small donations add up. For number 4, are you paying off a student loan? Even if you aren't paying this yourself, you can take the deduction for it as long as you are the one who is obligated to pay. If someone else pays the loan, the IRS views it as if you were given the money and used it to pay the student loan. Take a look and see if you qualify. Next, have you been paying for the care of a child or dependent this year? If so, up to $6,000 of qualifying expenses can be used for the Child and Dependent Care Tax Credit. Check it out. For number 6, if you're a low or moderate income family, you may be eligible for the Earned Income Tax Credit, known as EITC. The credit is meant to benefit working families with children. So if you have 3 or more qualifying kids, the credit could be worth up to $6,660 for you for tax year 2020, and could net you a refund even if you don't have any tax. The next overlooked deduction, the state income tax you paid on last year's return. Yep, you can add that to any other state income tax, up to $10,000, and use it as an itemized deduction. Number 8, were you called for jury duty this year? If your company paid you while you did your civic duty and your employer then required you to hand over your jury duty pay from the court, you can claim the amount that you handed over as an adjustment to your income. And last but certainly not least, let's talk mileage. Deductions for medical miles are subject to an overall adjusted gross income threshold for total medical expenses and worth 20 cents per mile in 2020. Charity miles are fully deductible at 14 cents per mile in 2020. But a word to the wise, keep good records. It doesn't have to be fancy. Even a spiral notebook is fine. But make sure to keep track of the date, miles, and medical or charitable purpose of each trip, as well as any monetary donations you make. And also note the market value of any in-kind donations such as clothing and household goods. Today's takeaway: explore which deductions you may qualify for this year. Becoming knowledgeable about possible deductions may really give your refund a boost. For more information about TurboTax Live, visit turbotax.com, where you can file with the help of an expert or let an expert file for you. This is TurboTax Tips, expert tips for real people. Maybe you've already set aside savings in your IRA and HSA, but did you know contributions you've made to those accounts could be tax deductible? And the timing of when you make payments or contributions is also important. In part 3 of our series 5 Hidden Ways to Boost Your Tax Refund, we have our 3rd and 4th tips to take your planning and saving one step further. Let's start with our 3rd tip. It's about maximizing your IRA and HSA. Individual retirement accounts, or IRAs, are considered an above-the-line deduction by the IRS, meaning you can take it regardless of whether you itemize or claim the standard deduction. You have until the May 17th filing deadline, unless it's delayed due to a weekend or holiday, to open or contribute to a traditional IRA for the previous tax year. This means you can make a contribution that counts for your 2020 return by May 17th, 2021. That also gives you the flexibility of claiming the credit on your return, filing early, and using your refund to open the account. And although contributions to a Roth IRA, which is different from a traditional IRA, don't give you a deduction, they still qualify for the valuable Savers credit if you meet income guidelines. If you're self-employed, you generally have until October 15th to contribute to certain self-employed retirement plans, provided you filed an extension by the tax deadline. Now, let's talk about how to maximize your HSA. Pre-tax contributions to a health savings account, or HSA, will also reduce your taxable income. Like with an IRA, contributions can be made until the May filing deadline as well. Certain requirements must be met in order to open and contribute to an HSA, though. Here's what those requirements are. You must be enrolled in a health insurance plan that has high deductibles that meet or exceed the IRS's required amounts. That plan must also impose the maximum annual out-of-pocket cost ceilings that meet the IRS's limitations. But keep this in mind. You won't be able to participate in an HSA if any of the following are true. You have other first dollar medical coverage, you enroll in Medicare, or you're claimed as a dependent on someone else's tax return. While savings accounts can help you at tax time, paying attention to the time of year before making payments or contributions can also give your refund a boost. It's our 4th tip. Look for payments or contributions that you can make before the end of the year that will reduce your taxable income. Here are a few examples. If you can, make January's mortgage payment before December 31st and get the added interest for your mortgage interest deduction. Here's another one. Schedule health-related treatments and exams in the last quarter of the year to boost your medical expense deduction potential. And maybe this could be the time to make some charitable contributions. Just make sure it's a qualified charity and that you're keeping track of your expenditures. Also, if you're self-employed, look at any purchases you'll need to make that can qualify for deductions. And if you're able to claim the home office deduction, you can even deduct the cost of painting your home office. It could be the time to give it a little makeover. Here's why this matters. Planning ahead and being prepared could really save you down the line. Learning to maximize your IRA and HSA and how timing can reduce your taxable income could mean a larger refund for you. And who doesn't want that? For more information about TurboTax Live, visit turbotax.com, where you can file with the help of an expert or let an expert file for you. This is TurboTax Tips, expert tips for real people. Who wants to pay more taxes than you owe? No one. Who wants to get more back this year? Everyone. For the latter, we're getting credit savvy and refund happy in the final part of our series 5 Hidden Ways to Boost Your Tax Refund. Our 5th tip involves tax credits. They usually work better than deductions as refund boosters because they're a dollar-for-dollar reduction of your taxes. For example, if you get a $100 credit, you get $100 off your taxes. Many people leave money on the table when it comes to claiming tax credits. So today, we're highlighting a few, like the Earned Income Tax Credit. 20% of eligible Americans don't claim this one. If you're working and meet the guidelines, you may be eligible for the EITC even if you're single with no children. If you have no qualifying children, the maximum credit amount is $538 for 2020. But if you have 3 or more qualifying children, the maximum credit jumps much higher to $6,660. In general, if you have kids, it can pay to claim the Child and Dependent Care Credit as well. And here are some valuable education tax credits. Are you a college student, or are you supporting a dependent child in college? If so, you could be eligible to claim the American Opportunity Credit. It's refundable up to $1,000. That means you could receive as much as $1,000, even if you don't have a tax bill. The total credit is $2,500 and applies only to the first 4 years of undergraduate qualified higher education expenses. Also, if you're in grad school or beyond, you may be eligible for the Lifetime Learning Credit. For 2020, you can claim 20% of your qualified costs up to $10,000, which translates to a maximum of $2,000, depending on your income. Now let's talk tax credits for energy-saving home improvements. Maybe you've been working hard to make your home a little more green. It could pay off. The credit for 2020 through 2022 is up to 26% of the cost of qualified energy-producing improvements. This is reduced to 22% for 2023, after which it goes away completely. So for example, if you installed solar panels in 2020 at a cost of $20,000, your total credit is $5,200. Any portion unused on your 2020 tax return carries over to 2021. But carryovers don't apply to the credit for qualified electric vehicles. It shouldn't be less of an incentive to buy one, though. The IRS is still offering $7,500 per qualifying vehicle for 2020, which phases out once a manufacturer has sold 200,000 qualifying vehicles. You don't have to know the ins and outs of these tax credits. TurboTax will help you with that. Just know that these credits can save you money. For more information about TurboTax Live, visit turbotax.com, where you can file with the help of an expert or let an expert file for you. This is TurboTax Tips, expert tips for real people. Most recently,
10 ways to reduce company tax liability. How to minimize your small business tax liability. How to minimize your small business tax liability. Business tax liability is complicated, and we'd be willing to bet you're not taking full advantage of the strategies designed to help you. Today we're breaking down 10 ways you can minimize your tax liability, decrease your estimated quarterly taxes, and spend your business dollars smarter. What is tax liability? Your tax liability is the amount for which you're responsible to the IRS. Tax liability is determined by your tax rate and your amount of income. Reducing your tax liability means taking advantage of all of the deductions you can and minimizing the bottom line total that's used to calculate your tax bill. There are several strategies for using your gross revenue wisely so that less of it is eligible for taxes and so that your taxes are working harder for you. Employ family members. It's not possible for every small business, but if you hire a family member you can skip some of the employer taxes you'd be paying for another employee. If you hire a spouse you are not required to pay unemployment (FUTA) taxes, and for children, you aren't required to pay employment (FICA) taxes. 4B 10 ways to reduce company tax liability. Build a retirement fund. Not only is it common sense to save for retirement, it can actually help you pay less in taxes. As a small business owner, you can save up to $57,000 per year in total retirement contributions. These contributions are totally tax-free, and you have a few options for executing this strategy. Simple IRA equals Savings Incentive Match Plan, Individual Retirement Account. As an employer you can require a 2% contribution from employee paychecks to their retirement fund, or offer an employer match up to 3%. Employees can contribute $13,500 per year, and an additional $3,000 for employees over the age of 50. Roth IRA equals Individual Retirement Account, allowing for tax-free qualified withdrawals. These savings accounts are preferable for those making less than $140,000 annually and who think taxes will be higher for them in the future. The money is taxed when it goes into the account but can be withdrawn tax-free. However, the employer match is pre-tax money. 403(b) equals a retirement account for certain non-profit and public school employees. Like other retirement plans, employers can match employee contributions pre-taxes and can maximize benefits if employees stay for 15 years of employment. Simplified Employee Pension Plan (SEP) equals a retirement account with higher contribution limits available for self-employed individuals. A simplified retirement account that provides employers tax-free contributions as well as a tax credit when initiating the plan. 4B 10 ways to reduce company tax liability. Build a retirement fund. Not only is it common sense to save for retirement, it can actually help you pay less in taxes. As a small business owner, you can save up to $57,000 per year in total retirement contributions. These contributions are totally tax-free, and you have a few options for executing this strategy. Simple IRA equals Savings Incentive Match Plan, Individual Retirement Account. As an employer, you can require a 2% contribution from employee paychecks to their retirement fund, or offer an employer match up to 3%. Employees can contribute $13,500 per year, and an additional $3,000 for employees over the age of 50. Roth IRA equals Individual Retirement Account, allowing for tax-free qualified withdrawals. These savings accounts are preferable for those making less than $140,000 annually and who think taxes will be higher for them in the future. The money is taxed when it goes into the account but can be withdrawn tax-free. However, the employer match is pre-tax money. 403(b) equals a retirement account for certain non-profit and public school employees. Like other retirement plans, employers can match employee contributions pre-taxes and can maximize benefits if employees stay for 15 years of employment. Simplified Employee Pension Plan (SEP) equals a retirement account with higher contribution limits available for self-employed individuals. A simplified retirement account that provides employers tax-free contributions as well as a tax credit when initiating the plan. Focus on healthcare. If you have a high-deductible health care plan, you may be eligible for health savings accounts (HSAs), which make it easy to save tax-free money to be used for health and wellness spending. Both contributions and withdrawals are tax-free, which makes this option particularly appealing. Raises might seem like an easy win, but you'd actually be better off contributing more to your employees' healthcare. A raise is subject to employer taxes, with FICA and FUTA taxes being withheld like regular wages, and then taxed on the employee side as part of their income. Instead, you can cover more of their health insurance costs without paying any taxes. Get incorporated. If your business operates as a sole proprietorship or other business structure, it may be beneficial for your tax liability to make the switch to a limited liability corporation or LLC. Many small business owners are able to omit the employer portion of their FICA taxes and decrease their tax liability. Further, you can have your first $50,000 taxed at a lower rate if you are structured as a C corporation. Maximize deductions. Work closely with a tax professional to understand exactly what you can deduct in your business expenses. Hint, it's a lot. From travel to office supplies to marketing, you can deduct ordinary and necessary expenses to reduce the amount taxed. The same can go for credits. In order to deduct your expenses correctly and apply tax credits, you'll need meticulous records. Set up your books and expense management to categorize your tax-deductible expenses and be sure to capture receipts for future access. Contract employees. When you hire freelance employees or independent contractors, you are able to get quality work for a smaller portion of the taxes. You are not responsible for their employment taxes or healthcare costs, but can still get the same, if not better, results. Charitable contributions. Making charitable contributions is a great way to pay it forward and to establish trust with your customer base. Choose meaningful and effective charities and then keep careful track of your donations. You are able to deduct up to 25% of your taxable income in charitable donations, so it's always a great option for building a reputation and reducing your tax liability. Optimize deductions. It's critical that you deduct everything for which you are eligible to minimize your tax liability. But you shouldn't stop there. For some business expenses, you're able to choose between two ways of deducting the expense. For example, for cars and travel, you can deduct the cost or use the IRS standard mileage rate for deduction. Another example is using large purchases as a whole item deduction or deducting depreciation over time. Keeping meticulous records allows you to compare the advantages of each method and to choose the one that will provide the greatest return. Tax law is changing constantly, and the way you completed your taxes last year might not work this year. Stay up to date on the current tax regulations and deduction particulars so that you can take full advantage of the most recent changes. Contract with a tax professional if you don't have your own accounting team. Adopt accountable plans. If you need to reimburse your employees for mileage, travel, or other expenses, you can save money on taxes by adopting accountable plans. It means that the reimbursements are not counted as part of W-2 income and are exempt from FICA and FUTA taxes. Put money back into your small business. It's not too late to minimize your small business tax liability with some carefully placed purchases or donations, and managing the way you deduct expenses for your business. Talk with your trusted tax professional to determine the best course forward for your company. Top year-end tax planning tactics for small business owners. Year-end tax planning is a great way to reduce the cost of your tax bill, but you need to make these moves before December 31st. Taxpayers don't need to be experts on all things tax law to get the most out of their next tax return. Here are 6 common small business tax moves that can help you cut your tax bill. Defer business income until January. Tax season is often best understood as, the bigger the bottom line, the bigger the bill. It's no surprise, then, that one of the most common tax planning strategies is to reduce your earnings in one year by deferring that income to the next year. If you operate on a cash basis and have a bunch of invoices to send or accounts receivable to chase, consider waiting until January 2023. Any business income you defer until the new year won't be taxable until 2024, meaning you'll have to pay taxes on it, but not for another year. Salvage bad debt deductions. No one wants to write off accounts receivables as bad debt. But if you do, it can save you money on your federal taxes. If you use the accrual bookkeeping method and someone owes you money that you can't collect, you may have what's known as bad debt. The IRS allows you to deduct the cost of bad debt from your tax return, but you need to prove that you took reasonable steps to collect the debt. To be deductible, the amount owed to the taxpayer must have already been included in the taxpayer's income. When determining your business's taxable income, you deduct its bad debts from gross income. Business bad debts may be deducted in part or in full. You can claim a business bad debt using either the specific charge-off method or the non-accrual experience method. Use the final weeks of 2022 to attempt to collect all outstanding payments, and be sure to keep a detailed record of your debt collection efforts. Anything that feels like a lost cause can result in tax savings. Find full instructions on claiming bad debt as a tax deduction on the IRS website. Make office improvements and repairs. The cost of making minor repairs to your business premises should be tax deductible, so, if you can, make all necessary repairs before December 31st. The IRS categorizes the cost of property maintenance as either repairs or improvements. You can generally deduct the cost of a routine repair within a single year. On the other hand, the cost of improvements generally needs to be depreciated over a period of up to 27.5 years. Changes to a property are classified as improvements when they include betterment, adaptation, or restoration. Be careful if you're improving a home office area. Even in light of the pandemic, there are strict rules for what qualifies as a home office. Mainly, the space must be used solely for business purposes. A garage used solely to house inventory? Home office. But if you also park your car in there? Not a home office. Before approving any expenditure on office maintenance and repairs, it's a good idea to have your CPA or tax advisor determine whether it can be deducted as a repair or as an improvement. With a premium tax subscription, you get unlimited, on-demand access to consultations with our in-house tax professionals. They'll help you with questions just like these to ensure your tax bill is as small as it can be. Take advantage of new business deductions. Did you start a new business or venture in 2022? As long as your startup expenses did not exceed $50,000, you can generally deduct $5,000 in business startup costs during your first year of business. If you incurred over $50,000 in startup costs, your available first-year deductions will be lowered by the amount that you exceed $50,000. For example, if you spent $52,500, you'd only be able to deduct $2,500. To qualify for this tax deduction, the venture must launch before year-end and be an ongoing activity. Also, if you researched a business that failed to launch, you may still be eligible for a tax deduction. Whether you're able to deduct the costs incurred here depends on the specificity of the research you completed. If you were investigating a specific business to create or acquire, you might be able to deduct these expenses on your personal or corporate tax return. Alternatively, if you don't have a specific business in mind and nothing comes of your research, you can't deduct the costs you incurred during research or investigation. This deduction is complex, so consult with your CPA, or, if you're a Bench Premium subscriber, one of our in-house tax professionals, to determine what is and isn't deductible for any given year before you claim it on your return. Consider a change of business entity type. According to census data, 73.1% of all small businesses are sole proprietorships. This is largely because sole proprietorships are so easy to start. You don't need to file paperwork or make a declaration to the IRS to start a sole proprietorship. In fact, if you started a side gig in 2021, you might be a sole proprietor and not even know it. But sole proprietorships aren't taxed as a separate entity. Instead, they're considered pass-through entities, meaning their business income and expenses are passed onto the business owner and recorded on Schedule C as part of Form 1040, the individual income tax return. As a result, your business pays the same tax rate you do, depending on your income bracket. Each business structure has its own tax benefits and drawbacks. Incorporating can potentially reduce your tax liability, especially since the Tax Cuts and Jobs Act, or TCJA, lowered the corporate tax rate to 21% in 2017. It can also save you money on self-employment tax. But that doesn't mean it's best practice for everyone. The cost of incorporation can get expensive and comes with stricter reporting requirements, which can add a lot of paperwork to your to-do list. Whether it's a C corporation, S corporation, or limited liability company, making a switch to a new entity type can greatly impact how your business is taxed. Talking through your options with a tax professional, or your in-house bench tax advisor, can help you identify which entity type will best suit your needs. 8 year-end tax tips for small businesses. Tax credits and deductions can save your business money. Filing taxes is an unavoidable chore, but it's a necessary part of running a successful small business. The good news is that you have opportunities to save money on business taxes by claiming deductions and credits, and making smart moves at the end of the tax year. Paying attention to timing is critical for leveraging tax benefits for your small business. Doing some year-end housekeeping can help you make the most of any tax breaks your business qualifies for. Key takeaways: year-end tax planning can help to maximize opportunities to claim deductions and credits for your small business. Using surplus cash to pre-pay expenses or stock up on supplies and inventory can increase your deductible expenses for the year. Deferring income could help you to push tax liability into future years, but it's important to consider how that can affect your business financially. 2017 tax changes to remember for year-end tax planning. The 2017 Tax Cuts and Jobs Act, the Trump tax cuts, instituted a number of changes to the way small businesses handle taxes. These tax changes below could impact your business taxes, so it's important to remember them at the end of the year. Eligible businesses can claim a 20% deduction from net business income, subject to restrictions and limits. Certain deductions for small business have been eliminated, including the deduction for entertainment expenses if you have bought or plan to buy large capital items like vehicles, machinery, or equipment. Higher first-year depreciation limits could save you money. Note: you may want to consider hiring a tax expert to help you with filing business taxes if it's your first time doing so. Stock up and pre-pay expenses. Claiming a deduction for eligible business expenses can save money, as deductions reduce your taxable income for the year. If you have any cash sitting around, or you can reasonably use your credit line or a business credit card for purchases, stocking up on supplies or pre-paying certain expenses could give you a larger deduction. Replenish office supplies or any supplies you use regularly. Stock up on inventory, especially if you're able to find it at a discount. Pre-pay insurance coverage for the next year if you use subscription services. Switch from a monthly to yearly payment. Set up a 401k plan for employees. Setting up a 401k for yourself and your employees is another way to save on business taxes. You can claim a tax credit for your business for the cost of setting up and administering a 401k plan, up to $500 a year for each of the first 3 years the plan is in existence. Point 2. Even if you have a sole proprietorship, you can still use a solo 401k to set aside money for your retirement and save on business taxes. The potential tax savings could more than pay for the cost of setting up the plan and funding it. The Department of Labor suggests following these steps: adopt a written 401k plan, document, arrange a trust for the plan's assets, develop a record-keeping system to keep track of contributions, provide plan information to employees who are eligible to participate. 3. Note: a bank or brokerage can help you set up a plan for yourself and your employees. If you'd like to create an individual 401k, you can start the process online through a brokerage that offers them. Write off bad business debts. Bad, uncollectible debts can be written off before the end of the year, and the uncollected debts can be deducted from your taxable business income. The IRS also includes unpaid loans and business loan guarantees under the bad debt umbrella. To deduct bad debts, you must use the accrual accounting method, run an accounts receivable aging report to see which receivables are unpaid from customers or clients, make note of which debts you may still be able to collect on and which ones have a high certainty of remaining unpaid, add up all bad debts you want to write off and review the list with your tax advisor. Just know that if you receive the money from the customer later, you will have to reverse the write-off and declare the payment as income. Write off or write down obsolete equipment and inventory. Obsolete, damaged, or worthless equipment can be taken off your accounting records to increase your expenses and lower your tax liability. You can write it down, meaning you reduce its value for tax purposes, or write it off, in which case its value drops to zero. Review your business inventory and equipment. Mark items that are obsolete, worthless, damaged beyond repair, or damaged but still usable. List the full value of the items that are obsolete or worthless for write-off. List the reduction in value for items that are damaged but still usable for write-down. Claim the total expense for write-offs and write-downs as a deduction when you file your tax return. For example, if you have a computer that you purchased for $2,000 and it's sitting in a back room because it no longer turns on and you bought a new computer, you can expense the full $2,000 purchase price because the computer is obsolete. If a piece of equipment costs $1,000 new and you feel its value is $300 less because of damage, you can list $300 as an expense, reducing the book value to $700. Give employees bonuses or gifts. In addition to receiving a tax deduction for paying bonuses or gifts to your employees, you may also receive much goodwill from employees, especially around the holidays. Bonuses to employees of all types of companies are deductible business expenses if they're considered additional pay for services, not gifts. But bonuses to sole proprietors, partners, and limited liability company (LLCs) members are not deductible, because the owners, partners, members are considered by the IRS to be self-employed. Note, holiday gifts and holiday parties may be deductible as long as they are not routinely, frequently given and are for the purpose of promoting goodwill. Claim bonus depreciation and Section 179 deductions. Changes to the tax code allow for accelerating depreciation on certain types of business equipment. In simpler terms, these provisions allow you to expense more of the value of business equipment purchased this year, for a larger tax deduction. Bonus depreciation allows businesses to depreciate up to 100% of the adjusted basis of certain qualified property during the year that the property is placed in service. If that property is placed in service between September 27, 2017, and before January 1, 2023.7, you should be aware that some states modify or deny bonus depreciation. Check with your state Department of Revenue to see what the provisions are in your state. Section 179 Depreciation. Section 179 allows taxpayers to deduct the cost of certain property as an expense when the property is placed into service. That includes machinery, equipment, and qualified real property. The current maximum deduction is $1.08 million, with a phase-out limit of $2.7 million. Purchase energy-efficient vehicles and property. If it's in your budget to upgrade vehicles or property, you could see a decent tax break at year's end. Energy-efficient property. The 179D deduction allows businesses to claim a tax benefit for energy-efficient improvements made to commercial properties. The tax deduction is $1.88 per square foot for owners of new or existing buildings who install energy-efficient lighting, heating, cooling, ventilation, and hot water systems. Building envelopes are also eligible for the deduction. Alternative motor vehicles and hybrids. Section 30D of the Internal Revenue Code provides a credit for the purchase of alternative motor vehicles and hybrid cars, including plug-in electric vehicles. You must be the original purchaser of this vehicle. The total tax credit is capped at $7,500 per vehicle. Time your income and deductions. One final year-end tax tip for small businesses revolves around deciding when to time the receipt of income and when to pay expenses. Getting the timing right matters for maximizing tax savings. Deferring income as you get to the end of your business tax year, you may have the option of taking income in this year or next year. If you can take income in the year of the lower profit, you may be able to minimize your taxes. For example, if this year you will have a loss, but you know you will have a profit next year, you may want to encourage customers to pay you this year when your profits will be lower. If you think your profit will be lower next year, try to move payments from customers into next year. This is tricky, since you don't really know what will happen next year, but it is worth a discussion with your tax advisor. Timing deductions when considering whether to take a deduction for an expense this year or next year. Here are 3 points to take into account. Take the deduction in the year when your profit is higher. This will result in lower profits in that year. Take the deduction in the year when the deduction amount is higher. Some deductions change from year to year. Learning about these changes can save you money by allowing you to take the deduction when it is higher. Take the deduction in the year when the tax rates are higher. If you know that business tax rates will increase next year, take the deductions next year to minimize your taxable income in that year. The principle of timing income and expense deductions, if done thoughtfully and with the assistance of your tax advisor, could lower your business taxes. 6 year-end tax planning tips for your small business. End-of-year taxes are a significant part of tax planning for any business. Even if you're a sole proprietor with no other employees on your payroll, you can significantly affect the amount of tax you end up paying at year's end depending on the amount of planning and preparation you put into business tax management. By planning ahead and paying attention to your taxable business income, it's possible to take advantage of timely tax breaks, strategically manage your revenue and expenses, and use tax deductions as an incentive to reward both yourself and your employees. Here are 6 strategies you should use to complete tax planning for your business. Invest in business equipment, supplies, and other assets. At the end of the fiscal year, businesses can reduce their taxable profits by purchasing equipment, supplies, and other assets that will be used in the coming year. This can be a great way to reduce your taxes owed in one tax year, especially when you expect that tax year to have a higher taxable profit than the year ahead. Prepay for services you will need the following year. Similar to investing into business equipment, you may choose to prepay for a number of different services you will use in the coming year. This can include business insurance, professional memberships or association dues, business rent, and other guaranteed fixed expenses. Write off bad debts that have gone unpaid. Certain aged, unpaid accounts may be eligible to use as a write-off on your taxes. This is done when an amount owed by a customer has not been paid and is expected to remain unpaid. By writing off this debt, you can reduce your company's tax burden for the current tax year. This process involves some potential complications, including the fact that if the customer ends up paying their bill in the future, you have to reverse the write-off you gave yourself on your taxes. To ensure this process is properly handled, it's best to address bad debts in collaboration with your tax advisor. Accelerate income, or defer earnings, based on profit projections. When it comes to certain year-end revenues, businesses can use some creative accounts to accelerate income, which means claiming revenues early to count them in the current tax year. This is done to claim what you anticipate will be a lower tax rate, saving your business money in the long run. By contrast, you can choose to defer certain earnings into the next year, which pushes that income into the 2021 calendar year and gives your business some much-needed tax relief for the current tax year, while hopefully saving money on your taxes owed in the long run, if next year's taxable revenue is lower. Use retirement contributions and bonuses to reduce tax obligations. At year's end, some businesses may choose to provide end-of-year bonuses or retirement contributions to their employees, taking advantage of a tax break on these funds. If your business doesn't currently offer a retirement plan, certain tax breaks exist to make this more financially appealing, and the end of the tax year is a great time to set this plan up. Consult with your tax advisor to make sure this process is handled properly. Pay close attention to changes in small business tax law. Tax law changes are relevant to businesses in any tax year. For the 2020 tax year, though, legislative changes at state and local levels, including the CARES Act and PPP loans, may offer crucial tax savings, or create restrictions around the types of actions you can take to reduce your tax obligation. It's important to be aware of these tax implications when planning out your year-end business taxes. To ensure you capitalize on all tax deductions while steering clear of trouble, you may want to consult with a tax advisor who specializes in business tax law. Don't fall victim to short-sighted business tax planning. Businesses of every size should think ahead when it comes to planning out taxes and reducing how much they owe Uncle Sam. With proactive tax planning, you can account for new tax law changes and take advantage of other business deductions that minimize your taxes owed come tax day. Find a bank that offers business services to support your tax planning and other operations.
For help with all of your tax and legal questions, investing, business structure setup, etc., Again, investment, etc. We recommend Mark J. Kohler. As you can see, he handles entrepreneurs, 401ks, etc., tax questions, any of your tax questions. Again, entrepreneurial questions, legal questions, etc., investing, wealth building, etc. So again, we directed IRAs, etc. So we recommend Mark J. Kohler and his associates for any of your tax and legal questions for your business, for your personal structure. You can find links to Mark J. Kohler Tax and Legal site on the About page of our Virtual Consulting 101 YouTube channel. Also in the links section on our homepage at thebcf.com, etc. So again, you can quick and easily find links to Mark J. Kohler on our YouTube channel and on our home site, thebcf.com. And again, for any of your tax and legal questions, business structure questions, investing, etc., we would recommend and we use Mark J. Kohler and Associates. So we hope that helps as well. Here are some more end-of-year tips that can help you minimize your tax liability for next year, utilizing barter or trade. If you are already a member of a trade exchange, already engaged in barter and trade, you can minimize your taxable barter income for this year and or conserve your cash before the end of the year by using these barter tips, this checklist of barter tips. And given the current environment where inflation is high, interest rates are higher, you can get a real return on your cash. It's always best to conserve your cash by utilizing trade or barter. If you're not already a member of a trade or barter exchange, you can do direct trades, direct barter. And again, these are all tips, checklist of tips that will allow you to reduce your tax liability for this year. So the first tip is to reduce your taxable inventory before the end of the year. If you're going to have to pay taxes on any inventory that you carry through the end of the year by trading that taxable inventory for other products or services that you're going to use for your business, you can again reduce your taxable inventory before the end of the year, and again acquire other products and services that you're going to need for your business. So the net tax on acquiring those would be a net zero, and again you can reduce your taxable inventory. By completing any necessary or planned business-related purchases that you can get on trade or barter before the end of the year, again, then you can get a tax deduction on those business expenses. And by utilizing trade or barter, again, you get to conserve your precious cash and still get the tax deduction for those business-related expenses. Also, pre-purchase any business-related services that you can get on trade or barter before the end of the year. If you're going to utilize a tax preparer next year, accountant next year, see if you can prepay and trade for those services and do so before the end of the year. Again, then you can write off those expenses as a deduction on this year's taxes, and again, you've conserved your trade or barter currency and or your cash by pre-purchasing those business-related services. Stock up on any business supplies. If you're going to need supplies going into the end of the year and you have the opportunity to trade or barter before the end of the year for those business supplies, again, now would be a great time to do so. You can get the tax deduction for those business supplies. Also, again, given the inflationary environment, the chances are those business supplies are going to become more expensive going forward. So now is a great time to utilize your trade or barter before the end of the year to stock up on your business supplies, get a tax deduction, and also minimize the cost going forward. If you do have excess trade or barter currency in your trade exchange, or again, excess inventory, taxable inventory, and you can get a further tax deduction for donating to a charity, here's a great opportunity to maximize your charitable contribution, your charitable deduction for charitable contributions this year by donating your trade or barter currency through your trade exchange to the various charities and or your products or services. Again, you can donate your taxable inventory to a charity and get a tax deduction for that donation. If you are a member of a trade or barter exchange, ask your broker or your trade barter exchange owners for what charities you could donate your trade currency to and or directly trade products or services to maximize your charitable deduction for this year. Also, another tip I really like is instead of giving your employees a cash bonus at the end of the year, why don't you buy or give them holiday gifts using your trade or barter currency and or something else that you can trade your products or services for that your employees would value and benefit from in lieu of giving them cash. So again, there's all kinds of things that you could give your employees as a holiday gift and possibly with a higher value than you would give them in cash. You get to conserve your cash and give your employees a nice holiday gift. And again, then you can probably get a taxable deduction for that business expense. So all of these are various tips that you can use to utilize trade or barter to minimize your taxable income for this year, and again conserve your cash. And again, since you can get a real return on your cash, and cash is going to be more scarce going into a recession with a high inflationary, high interest rate environment, it's always wise to conserve your cash by maximizing your use of trade or barter. If you are not yet familiar with how to utilize trade or barter for the benefit of your virtual consulting business and how to grow your virtual consulting business using trade or barter, we have a playlist on our Virtual Consulting 101 YouTube channel that explains all about trade and barter, how you can utilize trade and barter to grow your business. Again, you can see all of the various videos, and we will have subsequent videos that we will add to this playlist that will explain how you can grow your business with barter, how your virtual consulting business can benefit from trade and barter, and then again, we'll be adding further videos to this playlist. So find the barter playlist on our Virtual Consulting 101 YouTube channel, and that will explain again how you can utilize trade or barter to grow your business, grow your virtual consulting business utilizing barter. So we hope that also helps. If you are ready to get started with growing your business through bartering, you can find a link to a barter exchange, the iTex Barter Exchange, in the description box below, and also on this article, for which you will find a link to this article on the Virtual Consulting Firm's blog in the description box below. And you can click on that link and you can get started growing your business with barter right away. We are members of the iTex Barter Exchange and have been for 10 or 15 years. We've been very pleased with trading through the iTex Exchange and have been able to take vacations, get other products and services we need, sell more of our products and services through bartering with iTex. So again, we would highly recommend, if you want to get started growing your business through bartering, click on the link in the description box below or in this blog article, or you can find a image, an ad video graphic on the upper right hand corner of any of our web pages on the Virtual Consulting Firm blog at blog.thevcf.com. So again, if you're interested in getting started growing your business through bartering with iTex, you find the link in the description box below in this article and underneath the graphic on any of our web pages at blog.thevcf.com. If you have any questions about getting started growing your business through bartering with iTex, just let us know in the comments, in our Discord, through social media, etc. We hope that all helps. If you would like a copy of this end-of-year barter tips checklist that you can utilize for your business going forward as the start of a further checklist for your end-of-year business tips, We've added a copy of this Google document to the Patreons folder under our Virtual Consulting Google Drive folder, which is accessible to our Virtual Consulting Patreons, as well as other documents, tools, etc. that we provide to our Patreons. So if you would like to utilize a copy of this end-of-year barter tips checklist, all of our Patreon members have access to this Google Drive folder for our Patreon. So again, by joining our Patreon, our Virtual Consulting Patreon, for which you can find a link in the description box below, you can get access to this end-of-year barter tips checklist, as well as all the other tools, resources, etc. that we're adding to that Google Drive folder for the benefit and value of our Patreon. So we hope that also helps. We hope that you have found all of these end-of-year tax tips for your virtual consulting business to be helpful to you in helping you minimize your tax liability for this year, do your tax planning, and maximize your tax refund for next year, and also plan in the future to minimize your tax liability, maximize your refund, conserve your cash, and also how you can utilize trade and barter to also conserve your cash, to grow your business, to succeed in your virtual consulting business, both by the end of this year and going forward into future years. So please let us know in the comments below if you find that all these tips helpful to you in our free Discord, in our Facebook group, via our social media sites. Again, if you need additional advice on your particular tax situation, how to benefit and minimize your tax liability for this year, how to plan for your taxes going forward in the future, we recommend Mark J. Kohler. Again, we're not tax attorneys, we're not CPAs. We utilize the services of Mark J. Kohler for those types of tax, legal tax attorney and CPA type services. You can find a link, our affiliate link to Mark J. Kohler on the About page under links on our Virtual Consulting 101 homepage, also in the link section on the Virtual Consulting Firm's homepage, the VCF.com. So again, we hope all of these end-of-year tax tips help you minimize your tax liability, maximize your tax refund, conserve your cash, grow and succeed in your virtual consulting business. Again, let us know what you think of all of this. Do you have any additional end-of-year tax tips that you'd like to share? Again, the comments below in our free Discord, in our Facebook group, etc. So again, we hope this all helps. Good luck and have a great end of year. This video and the Virtual Consulting YouTube channel is powered by the Virtual Consulting Firm. Please also visit and follow us on social media via the links that you may find on our About page. In the top right, you can link to our Virtual Consulting homepage. You can follow us on Twitter, LinkedIn, etc. You can also find our web hosting company. And if you scroll to the bottom, you'll find additional links to some of our other social media sites, our Facebook site, our Instagram site. Also, we hope you will join us in the Virtual Consulting Facebook group, where we can discuss any topics and you can ask any questions related to virtual consulting, and we'd be happy to help you succeed in your virtual consulting business, get started and succeed in your virtual consulting business. And also our Pinterest, and again the web hosting company that we use for our homepage. So again, we hope you will also choose to follow us on our social media sites, visit us, let us know what you think of all this, how can we help you. We hope this all helps, and have a great day. We would also like to cordially invite you to join us in the new Virtual Consulting Community Discord server. You should be able to find an invite in the description box below, and or in the link section on our website on the Virtual Consulting Firm homepage, which you can also find a link to in the description box below at thevcf.com. And again, we'd like to invite you to join us and discuss any topics related to virtual consulting, etc., any help that you would need, in the Virtual Consulting Community Discord server. It is free to join. Again, any topics you want to discuss, any help you would like to have to succeed in your virtual consulting business, we can discuss those topics there, and hopefully our fellow virtual consultants will help each other out and mutually benefit from participating in the new Virtual Consulting Community Discord server. So we look forward to seeing you there. Again, you can find an invite in the description box below, in the About page of our YouTube channel, in the links section of our homepage, thevcf.com. And again, we look forward to joining you in the Virtual Consulting Community Discord server. Thank you. Please help us be able to continue to produce frequent quality content to help you learn how to get started and succeed in virtual consulting as a virtual consultant by supporting virtual consulting via our Patreon at patreon.com/virtualconsulting. Again, this is totally voluntary. If you would wish to provide us with your support, we would greatly appreciate it. You can see you can receive additional benefits, and we hope to be able to add additional benefits to each of these membership levels, any of which you may choose. And again, we'll be adding additional benefits to each membership level as we are able. So again, if you're able to help support us in being able to produce frequent quality content and additional benefits for our Patreons, we hope you will choose to select a membership in our Patreon at patreon.com/virtualconsulting. We thank you for your support. Good luck and have a great day. Thank you for watching our video to the end. We hope that you liked it. Please smash the like button to help the YouTube algorithm share our videos with more of your fellow virtual consultants around the world. Please share this on your social media and with your other virtual consultants around the world. If you're not already subscribed to our virtual consulting YouTube channel, we hope that you will choose to subscribe, and please hit the bell icon to be notified as we release new content. Please provide us with your feedback in the comments below. Let us know how we can help you be more successful as a virtual consultant, get started as a virtual consultant, and be successful in your virtual consulting business. Again, thank you for watching our video to the end. We hope this all helps, and have a great day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.